Over the last quarter, markets have had to deal with some extraordinary activity. When we're starting to talk about what's happening in the US political system, to what the US Federal Reserve are doing in terms of their purchases of assets in the marketplace, to the fact that there's been a significant de-risking in the European markets, as there is a lot of sort of traction behind a lot of the peripheral European countries actually moving back to a more balanced type scenario. And then when you actually look at Asia, what's happening in Japan, where Abenomics is basically taking on board a significant amount of stimulus for the Japanese economy, and the fact that the Chinese are essentially starting to show signs that it's not necessarily going to be such a hard landing scenario in terms of economic activity that's coming through. Markets have certainly been able to benefit from a lot of those particular situations, but the uncertainty that's really come through, particularly as a result of the US political and government shutdown, has really tried to sort of emphasise the fact that we are not in a world whereby a lot of certainty or a lot of activity is going to eventuate for these particular reasons. Australian investors have really benefited over the last 3 months, and it's primarily because the economic activity that's coming out of China has been probably above expectations. Now, there are a lot of changes that are happening, but what we've seen is resource stocks in particular probably actually doing a lot better, whereas before it was a lot of yield-based stocks, things like banks, telcos, that were really driving the market performance. Now what we've had is a bit of a situation where resources have taken on board the banner, and we've seen some support come through for a lot of commodity prices, but the one that's most important probably to the Australian economy and to Australian investors is iron ore, which has actually maintained quite a high degree of price stability over the course of the last 3 months. Our market is definitely going to benefit from any sort of global cyclical uplift in economic activity, and that's some of the stuff that we've seen. But it's all speculation just at the moment, because we haven't necessarily seen the confirmation of some of this economic activity. It's more so been in things like surveys and whether or not there is real tangible evidence that this cyclical uplift in the economy around the world is really going to hold. And that's what we need to look for going forward. What we have seen, particularly as a result of the uncertainty coming through from some of the things like the US government shutdown, is a lot of fluctuations happening in a lot of currency markets across the world. But one of the most important things that's happened is that the US dollar, throughout this particular scenario, has weakened. Now that's meant that you've actually seen strength on the other side coming through for the Australian dollar. Right? And in effect what that has done is it's eroded some of the benefits that we've seen in terms of some of the strength that some of the international markets have been able to sort of portray, because as a rising Australian dollar actually lessens the return impact on international investments. As a result of that, what we're doing is we're basically looking to provide more of a dynamic hedging strategy within our funds to be able to cope with this particular outcome. But nevertheless, things that are going to affect the Australian dollar going forward, it's very much where the growth is going to come through mainly from the Asia region, whether or not we're going to have economic stability, which from the Australian marketplace we're starting to see start to come through. The Australian market has gone through a federal election, and therefore that provides certainty for a lot of overseas investors that are looking at our market for that degree of certainty coming through. So all those factors, when you start to actually put them all together, has seen some significant support come through for the Aussie dollar, but it's mainly against the US dollar. And we need to be able to also look at the Australian dollar against some of the other cross rates like the British sterling, like the Japanese yen, and like the euro, to see whether or not it's expanded right across the globe. At the moment, what we've probably seen is the Aussie dollar has been strong against the US, but not as strong against some of those other countries. Looking at the fluctuations, particularly from currency markets, but also from other markets as well, the way that we are actually handling this in our portfolio is very much around, we see volatility as very much a characteristic that we want to grab hold of. So being able to be flexible in your portfolio decisions is a critical characteristic that you need to have in your portfolio, and it's one that we actually carry right throughout our investment management process. It is important for investors to also sort of take a bit of a view that just because things seem rosy and all the papers are basically having all these good news coming through, it doesn't mean that that's the way that the future is going to pan out. We've also got to be cautious and not necessarily following the herd in relation to a lot of investment trades that are going on at the moment. There is still a lot of uncertainty in the marketplace, and the market is very much buoyed by the fact that there is cheap money out there, so people can borrow at a very cheap rate and actually invest it into the marketplace. Now, markets haven't necessarily been driven by fundamentals. They've been driven by the fact that this cheap money is easily accessed and they can actually make a few more bucks basically by investing it into the marketplace. That's not a sustainable investment strategy. You know, we are in a position where what we need to see going forward is very much a catch-up. We need to see some backfill of economic activity to substantiate where markets are at the moment.